Good morning, traders, and welcome to BCR's first morning market analysis of 2026. First up, let's have a look at the dollar index. On the final day of trading in 2025, the US dollar held steady around 98.25, remaining near its lowest level since early October, and still on track for its largest annual decline in 2017. The dollar has fallen about 9.4% this year, weighed down by expectations of Federal Reserve rate cuts, narrowing interest rate differentials, fiscal concerns, and questions about the Fed's independence. Markets are also now watching the upcoming appointment of a new Fed chair, with President Trump expected to announce Powell's successor early next year. Minutes from Fed's December meeting showed most of the officials favor further rate cuts if inflation continues to ease, although there is some division over timing and scale. Technically, the dollar index is consolidating within a narrowing range with momentum weak and key support levels around 97.75, 97.11, and the September low of 96.22. Next up, let's have a look at WTI. Crude oil slipped to around 57.3 per barrel on the last trading day of 2025 and is on track for its largest annual decline since 2020, down nearly 20% for the year. Oversupply concerns continue to dominate sentiment, with investors focused on the upcoming OPEC meeting, geopolitical developments, and the US inventory data. OPEC is expected to maintain its suspension of supply increases until the first quarter of 2026, while geopolitical risks, including the US blockade of Venezuelan oil shipments and ongoing Middle East instability, have provided some support. Rising inventories remain a headwind. Technically, prices rebounded from the 54.88 low and are now trading between the key psychological levels of $57 and $60, with the broader trend still corrective rather than a confirmed reversal. Next up, let's have a look at gold. With most global markets closed for a New Year holiday, trading was thin. Spot gold closed 0.6% lower on the last trading day of 2025 at 43.18 per ounce, but still posted an impressive 64% gain for the year, which is its strongest annual performance since 1979. Short-term price action has been pressured by profit taking, with gold slipping below the key 43.81 resistance level. The broader bullish structure remains intact, supported by prices holding above the 50-day moving average at 41.80. Momentum indicators remain constructive, with resistance near 43.70, while initial support is seen around the 4300 to 4305 level, followed by 4271. Lastly, let's have a look at the Australian dollar, which stabilized around 66.75, marking its second consecutive session of support as expectations of a potential RBA rate hike continue to underpin sentiment. The latest RBA meeting minutes showed that the board is prepared to tighten policy if inflation does not slow as expected, with attention now turning towards Q4 CPI data, which is due on the 28th of January. Markets are currently pricing in around a 28% probability of a 25 basis point rate hike at the February 3rd meeting. The Australian dollar has also benefited from record commodity prices and is heading towards an 8.5% annual gain, which is its first in 5 years. Technically, the Australian dollar remains above the rising 25-day moving average at 66.43, but with momentum indicators pointing to a continued bullish bias as long as prices hold above the psychological level of 66 cents. Well, that's all for today's morning market analysis. We hope that you have a great new year. As always, manage your risk and happy trading.